Your mortgage servicer just changed, and you have absolutely no idea what that actually costs you. In fact, you might have never even received a formal notice. It just happened, and now your payment schedule is different. Your escrow account is mysteriously adjusted, and there are fees appearing that weren't there before. Here's what most homeowners don't understand. Mortgage servicer transfers aren't just paperwork shuffles. They are financial events that can reset your entire loan structure, create new penalties, and drain thousands from your equity. I'm going to walk you through the exact mechanics of how this works, step by step, so you can see the money literally moving out of your account and understand where it's going. What actually happens when your servicer changes? Let's start with the basics. Your mortgage is actually two separate things: the promissory note, your debt, and the servicing rights, who collects your payments. Banks constantly buy and sell servicing rights because it's profitable. They make money on every payment you make. When your servicer changes, a few things happen immediately. First, the new servicer has to absorb your loan into their system. That's not instantaneous. There's a 30-45-day transition period where your old servicer and new servicer are technically both responsible for your loan. Second, the new servicer has to conduct what's called a loan file review. They're basically auditing everything the previous servicer did. And here's where it gets interesting. If they find discrepancies, and they almost always do, they'll correct them. Correction is a polite word for recalculate what you owe. Third, they reset your escrow account. This is the big one. How your escrow account gets reset. Your escrow account holds money for your property taxes and homeowners insurance. The old servicer was holding maybe $3,000 or $5,000 of your money as a buffer. When the new servicer takes over, they don't just accept the old balance. They recalculate your escrow requirement based on current tax rates and insurance premiums. Most of the time, they calculate it higher than it actually needs to be. Why? Because they want a bigger cushion. It's not illegal, it's built into the servicing agreement, but it means your monthly payment jumps, sometimes by $50, sometimes by $200. Here's a real example. Let's say your old servicer had you paying $500 per month, including $300 for escrow. The new servicer comes in, recalculates, and decides they need $450 in escrow. Your payment is now $650. You didn't refinance, your loan terms didn't change, but your monthly cost just went up $150 because a new company took over. And if there's a discrepancy in the escrow account, if the old servicer miscalculated, the new servicer will charge you a shortage fee to make up the difference. That's anywhere from $100 to $500 depending on the size of the shortage. The payment schedule manipulation. Here's where it gets really sneaky. When your loan transfers, there's typically a 30-45-day lag before the new servicer takes the first payment. During that time, your loan is still accruing interest through the old servicer, but the new servicer is also preparing to take payments. This creates confusion about what your next due date actually is, and banks exploit this confusion. You might have been on a schedule where your payment was due the 1st of the month. The new servicer might assign you a due date of the 15th. That looks like a simple change, but it's not. It means your next payment is now 45 days away instead of 30 days away. That's extra interest that accrues on your principal. Over 30 years, these seemingly small schedule adjustments can add up to $5,000 to $15,000 in additional interest. But here's the part that really matters. If you don't catch this and continue paying on the old due date, you'll accidentally make an extra payment one month. The new servicer will apply it as a partial payment and hold it in a suspense account instead of crediting it toward your principal. You think you're ahead. You're actually stuck in a processing loop that takes months to resolve. The hidden fees. Nobody mentions when a servicer transfer happens. There are at least 6 fees that can hit your account. Transfer fee. This isn't always charged, but some servicers do charge $50, $150 to process the transfer. It's buried in disclosures. Escrow shortage fee. If the old servicer underfunded your escrow, you pay for it, $200, $500. Late fees from the transition. If a payment gets lost between servicers and it happens, you'll get hit with a late fee even though it wasn't your fault. That's $50, $200. Loan file review fee. Some servicers charge to review your loan, $75, $150. It's in the fine print. Wire transfer fees. If the old servicer has to wire funds to the new servicer, sometimes the new servicer charges you for that wire, $25, $50. Force-placed insurance. If there's any gap in your insurance coverage during the transfer, the servicer will force-place insurance on your home, their insurance at triple the normal rate. I've seen homeowners charge $2,000, $3, $500 for force-placed insurance that lasted 30 days. Added up, servicer transfers can cost homeowners $500, $3,000 in unexpected charges. The step-by-step protection strategy. Now, here's what you actually do about this. Step 1. Get ahead of it *** when you receive notice that your servicer is changing, and you will receive notice it's federally required. Save that letter. Your new servicer's name, contact information, and the effective date of the transfer. Immediately call your old servicer and request a payoff statement and final escrow accounting. Get it in writing. This is your baseline. Step 2. Verify your loan file transfer ** 15 days after the transfer date, log into the new servicer's portal and verify that your loan information transferred correctly. Check current loan balance, remaining term, interest rate, monthly payment amount, due date, escrow balance. If any of these are different from what you expected, call immediately. This is not a wait-and-see situation. Step 3. Document every payment ** for the first 90 days with a new servicer. Pay online and screenshot the confirmation. Keep a spreadsheet showing payment date, amount paid, confirmation number, balance shown after payment. If the payment goes missing or gets held in suspense, you have proof. Step 4. Audit the escrow calculation ** request the new servicer's escrow calculation in writing. Then check your county's tax assessor website for your actual property tax amount. Call your insurance agent for your actual annual premium. Add 10-15% as a buffer if the servicer's calculation is higher than this. File a formal complaint with the Consumer Financial Protection Bureau, CFPB. It's free, takes 50 minutes, and it works. Step 5. Look for the shortage fee ** within 60 days. You'll either receive a statement showing escrow surplus, they overheld money, or escrow shortage you owe. If it's a shortage, request an itemized breakdown. Challenge any fee that's not directly tied to actual taxes or insurance. ** What to do right now ** If your servicer just transferred, go to your servicer's website or your mortgage statement right now and verify the information I mentioned. Compare it to your last statement from the old servicer. If you notice discrepancies, you have 60 days to formally dispute them. That window closes fast. Second, if you're considering a refinance or taking out a mortgage soon, understand that servicer transfers happen randomly. Don't assume your servicer is permanent. Build them into your financial plan.